Good morning and welcome back to Almus Market Mornings. President Trump seems to be playing both good cop and a bad cop, pausing tariffs on most countries for 90 days while going full throttle on China after Beijing escalated. Not to be outdone, China responded with its own steep tariff announcements. What was once a trade dispute now feels like a high stakes face off. Markets are moving accordingly, the dollar is weakening fast, safe haven currencies are surging, and gold is at fresh record high. Softer US inflation data has only reinforced expectation of more rate cuts ahead. JK, with the US taking a selective pause and China digging in, how does this two-speed tariff strategy reshape the currency markets, especially with the dollar under pressure?
Yeah, good morning, Suraj. I think we'll come to the tariff side. But what is standing out now is a complete loss of confidence in the dollar and also the US assets actually. That is very apparent in the last few days. As you know, dollar index now trades at a new two-year low of 99.70, and Swiss franc going to 15-year low. And of course, yen also breaking dollar yen also breaking down. There is a sell-off in the U.S. uh, treasuries, which is considered to be the safest asset globally. This is happening despite weaker CPI number that actually gives a chance of rate cut for Fed. And then even the tariff pause, the 90 days pause for non-retaliatory countries was also not helpful for the dollar to uh, gain. So this is actually getting now reflected in the market across the board. We are seeing, including the commodity currencies, which are generally vulnerable to fears of recession, or now a stronger Canadian dollar, Australian dollar, and even the Chinese one, which had threatened to break out massively to the downside, has regained to 7.30 levels after the Chinese authorities said that they are not going to use the currency as a tool for fighting the trade war. So that is the headline, I would say, today: loss of confidence in the US dollar and the US assets. And even if you look at the stock market, while the 90-day pause announcement did lead to a big gain for Dow, Nasdaq, and S&P, in fact, Nasdaq gained as much as 12% on that day. But this is more like maybe short covering and opportunistic buying. But if that was something sustainable, it should have continued yesterday. But yesterday we saw the Dow falling by 2.5%, Nasdaq by 4%, and S&P by 3.45%. The futures still show them. On the negative side, bonds got sold up. The US yields now for 10-year is now pushing at 4.50 once again. Only the 2-year is lower. That's more based on the expectation of Fed rate cut, and then 30-year is also pushing towards 5%. And there was reports that Japanese were selling the US Treasury bonds yesterday, and not China, as what most people were thinking. Amid all this, of course, the tariff war is continuing between China and US. The 90-day pause to other countries has had only a limited impact on the market, because China and US trade war continuing is likely to be a big drag on the global markets. As per the latest, what I understand, the US has a 125% tariff on the Chinese imports, and China's own tariff on US goods is about 84%. This is a moving part that we need to track on an ongoing basis. But whether this is likely to continue, it almost borders on madness, because it's not something that is sustainable in a normal orderly market or orderly economic management. So I think this almost akin to a stage in 2018, when China had said that they will fight to the end, and then they ultimately the two came to the table. And I think it is going to be who blinks first, and insists on the other to come to the table, and that is what the market is looking forward to. And that may be one last good news that can help the dollar. But I think technically dollar has broken down several important supports. It traded as low as 99.17 early morning today, and the euro traded 2-year high of 1.13. 85 as well. Yes, dollar is continuing to weaken. Against the other EM currencies, it is holding somewhat steady, not weaker, but steady, but not gaining also. This is because of the overall risk aversion that is now spreading from stocks to the bond market. Whether this will continue will depend on what action the Fed takes or the government takes, because after the tariffs have been passed, which means that immediately there's going to be no increase in the revenue for the US government, and then they are also planning about the tax cut. So this will only worsen their fiscal position, and there is no a real good reason for holding on to US treasuries, particularly when the reserve managers and global investors are looking for diversifying into alternate bond market. So that's going to be a negative for the US for quite some time to come. And on the rupee also, it is the same. While it hit 86.70 in the Wednesday's trade after Chinese yuan weekend, and also the trade war intensified before the pass, it has gained about 0.5%, but not really gaining as much as the other major currencies. Not even broken 86.20. This once again because of the uncertainty surrounding the bond market direction and the policies. Eventually the policies. I mean, one should remember that the tariffs have not been removed. It's only a pause, and it all depends on how hard both the parties negotiate. So that is the theme that we can really note today, so dollar being extremely weak. Amid all this, the economic data has been actually ignored. CPI came lower than expected on all fronts. The big fall in the gasoline prices, led by global crude prices crashing, and then of course some fall in the food prices also helped. No respect for bond market after this, although Fed rate cuts could get some fillip. Then weekly jobless claims also were steady at 223,000. Continued claims actually fell more than 50,000. So that's another improvement in the employment situation. FOMC minutes showed that participants generally saw increased downside risks to employment and economic growth. But I think market was mostly looking only at the tariff-related news and also the China-US standoff. So. Going ahead, we have, of course, PPI data tonight, and then the important uh, announcement of the quarterly results from big companies, mainly the banks. So that is something that the market will look forward to. But there is definitely a bias to, sell the dollar, and also keeping away from the US bonds because of the reasons I stated. So how this bond situation can be, in fact, it is interesting to note that yesterday even the UK government postponed one of their 10-year bond issuances, looking at the market uncertainty. So it's a very telling commentary on how the governments also view the bond market to be right now. So how this can improve, I think at some point Fed will have to come and announce something. If not a rate cut, maybe they will start announcing some sort of a QE to buy long-term bonds, which is very much possible. And that's what the market is looking forward to. Until then, I think bonds will keep getting sold. Dollar, of course, will be on a more sustainable downward trend, if particularly if 100 breaks, and we see the gold leading the charge again, once again at a new high at 3,219. As I said earlier, rupee is steady. For rupee to perform along with the other major currencies, we actually need to see the risk aversion abate a bit, and also flows resume for India. Just for a perspective, in April we have more than 4 billion of outflows after, it's more than erasing the inflows that we have seen in the month of March. So that's the key for India. However, one should note that the rupee market is now much more freely moving. Between some band, RBI has not been seen either on the buying side or on the selling side in a big way. So that's a good free market development for as far as India is concerned. Even let me also say this, that the RBI policy, which was according to me a very good policy, RBI taking a proactive measure of cutting 0.25% interest rate and shifting from neutral to accommodative stance on the monetary policy was somewhat ignored by the market, kind of discounted, and also it shows that the market is more concerned about the global developments. Thank you.
Thank you, JK, and a lot of things to look forward to. And it seems like even to say what the number of what is the percentage of tariff between China and US, by the time people listen to our podcast, that number would have changed. That's the current situation in which we are living
Absolutely,
in.
absolutely, yes, yes.
And as you mentioned, dollar index in the meanwhile, because of the broad loss of confidence in dollar index has hit a 2-year low. There is a sell-off in US Treasuries. People are ignoring all sorts of economic data. CPI, even though it was a good number, encouraging more rate cuts by the Fed, the yields have actually gone up. Currencies have regained, even Chinese yuan, which was very weak due to fears of devaluation, has substantially gained. And of course, when rupee also cooled off slightly, but not as much as how other Asian currencies have strengthened. RBI policy also widely ignored. They cut rates by 25 basis points and shifted their stance from neutral to accommodative, and it was quite a pro-growth stance they have taken. That's it from us today. Thanks for listening. Have a very good weekend. We'll see you all on Monday. And by that time, I'm sure a lot of things would have already changed. So we'll see you all on Monday with a fresh round of updates. Thanks for
Suraj,
listening.
is Monday a holiday again, I think?
Yes, yes, yes.
So it will
So
be on
we'll see
Tuesday.
you all on Tuesday with the fresh round of updates. So a lot more for us to cover, JK, actually.
Yeah, sure. Thank you.
Thank you. Thank
Okay.
you.
All the best. Yeah.